Howard Marks is a legendary investor and founder of Oaktree Capital, which manages over $120 billion in assets. And in this video, I'm going to discuss his latest memo to his shareholders. Marks also released a memo back in August, which I covered in one of my previous videos. And back then, he discussed that we are out of the normal market cycles, where businesses and the economy grows until the Fed starts putting on the brakes through monetary policies, like raising interest rates, to try and prevent the economy from overheating, which then leads to a slowing down of businesses until the Fed uses monetary policies to rejuvenate the economy. But this current market situation we are in is caused by the virus, so it requires a solution for the virus. Just support through fiscal and monetary policy is just not going to be enough to bring back the economy the way it was before. But of course, that doesn't mean that additional stimulus packages are not necessary. The stimulus packages that businesses and individuals received was to replace the lost income and sources of revenues after millions received a pay cut or were laid off. And the virus is still here and still affecting many businesses. But the government isn't sending out another package yet because neither side of the political parties wants to give the other an edge before the election. In July, 17% of FHA secured mortgages were delinquent, and in New York, that number was even worse, at 27%. And the state and local governments are running out of money too. As many people are making less money, the state and local governments are seeing less money received in taxes. But the services of firefighters, EMTs, and the police, among others, are required more than ever. And so the local and state governments can't print money like the Fed, so additional aid is needed to maintain the essential services operating. So for the economy to recover, we first need a solution for the virus. And we need additional stimulus from the government to replace the lost incomes in people's pockets. And then Marx discusses how the low interest environment has affected the rise in asset prices. The most obvious effect of lowering interest rates is that it encourages people and businesses to borrow more, since they can borrow more for less interest, which encourages them to spend money, which in turn accelerates the economy as money flows faster between individuals and businesses. Another factor is that a lower expected yield on what is considered safe investments, like treasuries, brings down the expected returns on other investments, like stocks. Because stocks are more risky than treasuries, there is something called the risk premium added to the returns on stocks. For example, if the expected return on investing $100 into a treasury is 5% or $5, the expected return on investing in something else that is more risky, like stocks, needs to be higher. So if you invested in stocks, which is more risky than treasuries, and you invested $100, you might expect a yield of 7% or $7 instead of the $5 that you would receive in investing in treasuries. And this is because investors prefer safer investments like treasuries over stocks. So in general, if treasury yields go down, the yields on other investments also tend to go down, which also means that prices of these investments go up. Since the yield on an investment is simply the return on the investment divided by the price of the investment. And the Fed has been buying a record level of treasury bonds and notes between March and July, where they spent $2.3 trillion, which is 18 times more than what they spent in the 2008 financial crisis. So as safe asset yields go down, mostly due to the actions by the Fed pouring money into the bonds, investors will look elsewhere to park their money in to meet their investing goals, namely in riskier assets like stocks. But Marx doesn't say that we are in a bubble. He even says that he has high hopes for the big tech companies because the pandemic has forced businesses and individuals to adopt virtual meetings, e-commerce, and cloud computing for our everyday lives. And because there is so much growth and competition in the tech sector right now, Marx notes that once these rapid growing companies establish their business and spend less on growing, they will become much more profitable. And as these tech companies grow bigger, they also kill their competition and disrupt the established companies. And we've all seen examples of that happen as brick and mortar retail stores are forced to either offer services online or lose their customers to Amazon. But for the general market, Marx expects low returns because of the low interest environment that drags down yields across all asset classes. And he outlines all the decisions investors can make at this time. The first is to invest as normal while accepting the fact that your investments will have lower returns than normal. The second is to take out all your money out of risky assets and hold cash until the next downturn. The third is to invest in even riskier assets than you normally would to seek normal returns. And the fourth is to find niche or private markets to invest in, but this also entails a very high risk. So Marx concludes that there is no great choices to be made in the world of investing right now. Uncertainty is still very high with no vaccines and political turmoil, and during these times, asset prices are usually low, which creates high yields and buying opportunities. But asset prices instead are still very high, despite the high risk. So Marx is going defensive mode, although he doesn't share exactly what that means. But that's going to do it for this video. Don't forget to subscribe with the bell notification icon turned on, and let me know down in the comments your investing strategies and how you think about Marx's opinions. And I will see you guys in the next one.